Hello everyone and welcome to your Glassnode video report for week 11, 2023. So there is never a dull moment in this industry, is there? In the span of just 1 week, and really it was basically half a week, we saw 3 of the primary banking partners of the digital asset space essentially go into some kind of receivership or voluntarily wind down. This is a fairly significant and pretty consequential event because it really does give a bit of a light into the current hostilities in the US regulatory environment. But really what we're going to try and assess today is what are the implications? What were the initial reactions going on from investors? We did see USDC and Circle impacted. They had about 3.3 billion. And obviously this industry does not slow down over the weekend. So during that period of time where blockchain assets continue to trade, we can see these prices and uncertainty getting priced into markets where the banking system is closed during that time. So let's get stuck into it. But quite a significant week to get talking about. So it is one of the most consequential weeks. We saw Silicon Valley Bank being the largest of the 3, essentially went into receivership and taken over by the FDIC. This is something on the order of $200 billion bank, the 16th largest in the US and the 2nd largest bank failure. Now, it is important to note that this is not directly related to crypto. There is a lot of headlines that kind of conflate these things. There was essentially a duration mismatch with their bond portfolio. And this is a risk that is present in much of the traditional finance system. The other 2 is Silvergate and Signature Bank. Now, these 2, for Silvergate, they've gone into voluntary wind down, where basically all deposits are going to be returned. And for Signature, this is kind of the newest one in the mix. They are also going into receivership, into the hands of the FDIC. Now, the reality here is what we're basically seeing is the banking partners that operated with many of the exchanges, many of the crypto firms, many of the VCs, they're going to have to go through that process of reestablishing banking arrangements. So naturally, over the course of that weekend, there was an enormous amount of uncertainty. Are deposits going to be insured, which it seems at the moment they will be? So essentially, all depositors at those 3 institutions are going to be made whole. Equity holders and shareholders and management, on the other hand, different story. But what we've basically seen is over that weekend, particularly in the stablecoin realm, we saw volatility in the stablecoin space really since the first time since Luna collapsed. So what we're going to look at today is that view into the stablecoin portion of the market. We're going to look at some net capital inflow, so going quite big picture to understand is capital flowing in or out of this space. We're going to look at the preference for BTC and ETH and how the market essentially responded regarding to the majors versus stablecoins. And we're going to dive into the derivative markets and have a look at a couple of short squeezes because price has essentially rebounded from here. So we've kind of had a flash down to 19,000 and then back up into the 22, 24, actually at the time of recording. So a pretty volatile couple of days, a pretty consequential week. And what we're going to do is try and assess what happened using on-chain data. So as always, please do give a like, a share, and a subscribe for this channel. It does help us get to more people. As always, do let me know in the comments if you have any questions, queries, and we'll get through those. And it really does help me understand what it is you want to see, what you enjoy, and what we can do better. So let's get stuck into the analysis. Okay, so starting with our price chart, and essentially this has been our last couple of weeks in this fairly substantial pullback. We got down to about 19,600, and we have essentially recovered the entirety of this in just a couple of days. So a very, very volatile period, and we will come back and talk a bit more about just the violence of this move and some of the underlyings when we get to the derivative section. So I'll leave it for there. Now, what we are going to start with actually is on a couple of technical pricing models. Now, you don't see me use technical analysis that often, and here we are just using simple moving averages. This is not any kind of major rocket science. But the reason why I've selected this particular chart is because technical analysis, at least the way that I look at it, typically when you've got things like the 200-week moving average, which is up here in the blue, in the red, and you've got the 1-year moving average in the blue. And then below us, we have the 200-day moving average and the pi 111-day moving average sitting below. And you can see that at the moment, there is a confluence where they're basically prices squeezed between these two. The reason that I look at these particular models is because everybody else is looking at these particular models. The 200 week is a very, very common tool used in traditional finance, as is the 200 day and the 1 year moving average. These are all very, very classic moving averages. And it's one of those things, there's a great saying that in a sea of sand, a single flag becomes a target. And what that basically means is when you're standing out there in the desert and everything looks the same, and there's one flag somewhere out in the desert, and you can see it in your view, and everybody's going to look at it, they all move towards that same thing. So quite often these moving averages that are very popular are popular because price tends to react around them, and the reason that price reacts around them is because they're very popular. So it's essentially a game of network effects. So what's quite intriguing is that we're essentially range bound between these very, very popular and well-observed models. So therefore, should we get some kind of break above or below, that would be something that the market would observe and see and react to, and thus probably carries a bit of significance. So a really, really simple model to just pay attention to which direction do we go, and we're currently squeezed in between these things. Some kind of break above those popular models would probably be indicative. Right? It would give us a bit of a view on what the market's preference is, and lots of people will see that particular event. Now, moving on to the stablecoin space. So it's very, very uncommon that we get a nice volatile chart when it comes to stablecoins, but in this instance, we did. So what essentially happened is about 3.3 billion of Circle's capital was confirmed to be within Silicon Valley Bank. Now that has been fully determined to be, it's recoverable essentially. So we've seen the peg for all of these stablecoins recover. But this is all occurring on a weekend. So what we've basically seen is the market traded down to approximately the discount, 88 cents, about 12% discount. It's approximately what the market was estimating, the probability times the risk and the consequence, trying to understand what is the risk that Circle or USDC is no longer backed 1-to-1. Now, we also saw DAI here in purple trade down, not quite as low, but certainly followed USDC down. And this is primarily driven by the fact that about 65% of DAI is actually backed by USDC, as well as other stablecoins, which we can also see start to depeg to the downside. This is a GUSD and Paxos USDP. Now, we did see a bit of a premium emerge in Tether. Interestingly enough, it's kind of one of these interesting ironies that capital flows towards Tether, which tends to have one of the more, question marks around its history and its past. There's typically where a lot of, there's a lot of critiques around Tether and their transparency, and it's kind of ironic that during a time when a regulated banking institution in the United States is having issues, capital flows towards the asset that has higher lending. It's one of these interesting dynamics that we see play out. BUSD had a very, very slight premium, but as I said, they have all essentially converged back to their par level, and this is essentially a result of all their collaterals being confirmed to be A-OK. Nevertheless, to me at least, the very interesting dynamic was seeing how quickly DAI and how closely DAI followed USDC. So really, it kind of demonstrates as a bit of a tethering between what's going on in the decentralized finance industry and the traditional finance industry, just on the basis of the collateral. Now, as a result, we saw Tether dominance climb back up. It's now well and truly above 50%, about 56, 57% for Tether dominance. We can see significant outflows from BUSD. This is since minting has been essentially paused, and there will be no more BUSD minted by Paxos, who's the issuer. So BUSD has declined from about 16.5% to about 6% dominance now. USDC is still trading sideways between about 30 and 33%. It will be something important to pay attention to, in my view, over coming days to just assess whether USDC gets significant redemptions. And we're going to talk about this concept in a second, so hang on to that. Now, this chart here and this next one are both related. And these are, in my view, really important charts to track the really big picture. Is capital flowing in or out of this industry? So the assumption here is that generally speaking, people who come into the digital asset space will come in via the majors, Bitcoin and Ethereum, or they'll come in through stablecoins. That is the primary place that most capital, not all of it, but most capital will come through. So we can look at that and measure it by stablecoin supplies. If stablecoin supplies are growing, it means capital is coming in through stablecoins. And likewise, if it's decreasing, vice versa. And when we're looking at Bitcoin and Ethereum, there probably isn't a better metric to use than the realized cap. And that is that once people are acquiring these coins, it kind of becomes a real capital inflow when that capital comes off an exchange and is withdrawn or transacts on chain. So therefore, those transactions on chain, which is what creates the realized cap, we're valuing every coin at the time when it last moved. If a coin just sits on an exchange and is just churning around, is it really capital inflow or is it kind of trading? Once a coin is withdrawn, it's entered the space, it's in the market. So that's what this chart here is showing, the total aggregate market cap or realized cap, looking at Bitcoin and Ethereum realized cap plus stablecoin supplies. That's going to capture some 98% of all the capital in this space. It really shows where the vast majority of the wealth is held. And basically what we're looking at is where are we and what is the dominance relative to the total. So we're about 20% down in terms of realized losses. This is typical of a bear market. There's been about 20% capital outflow, and this is a combination of stablecoin redemptions and Bitcoin and Ethereum, literally losses, people who bought the top selling at a loss, and actually that's a capital outflow. So this chart here, which is actually the chart of the week and one that I would recommend people study and understand, because there's a lot of information packed in this one chart telling us about the overall capital flows in this space. So there are three traces here. One of them is an area chart, which is either green or red for obviously inflows or outflows. That's the total. That is looking at how much this red bar is changing, this red line here, the total realized value in the market, how much did it change over the last month? The orange curve is how much of that was BTC and ETH coming from the two majors. And the blue curve is how much of that was stablecoins. So what we can see is that during the 2020 and 2021 bull, there was a huge amount of overall capital inflow into the space, and note that it was primarily driven by the major two assets. Stablecoins were a bit of a laggard. They followed, actually after the first sell-off, stablecoins were still growing during that period of time. We can also see that stablecoins overall were a much smaller portion through most of the bull. But what we can also see is there's periods of time where stablecoin growth was much larger and we had periods of net outflows coming from the majors. And interestingly, this is kind of starting to signal that the bear market was probably coming into effect. We can see that stables tend to lag this system. The majors are a lot more responsive. So we started getting capital decay coming out of this market as far as November 17. Right, so that's where we really started to see that massive decay, and really price was up at 48,800 by the time we were getting down to relatively low levels. Now, you can see that in the second half of 2022, we saw massive capital outflows again being led by the major two assets. Stablecoins were also in negative territory, seeing net outflows, but the majors are really where most of those losses were happening. And following the June sell-off and the FTX sell-off, these were our peaks in terms of total outflows so far. Now, February was a positive month. We had about 5.8 billion in net flows coming in, and that was primarily driven by the majors. In fact, we still had negative outflows of stablecoins. Much of this is driven by BUSD, by the way, which, as I mentioned, has entered redemption-only mode. Now, we have essentially reversed back to about 5.9 billion in net outflows per month at the moment. So this really here looks like a bit of a capital inflow, but the market isn't quite sure yet. It's actually looking a little bit like what we had back here in March 2020. You can see that we had a capital inflow followed by a capital outflow. Now, remember, that doesn't mean that March 2020 is coming, but it does mean that we're not exactly seeing raging bull market capital inflows just yet. So it's one of those things to just understand the overall capital flows coming in and out of the market. This is a really powerful chart because it contains, in my view, the reality of money flowing in and out of the system. And if you do want to inspect this even further, you can always pull this up in Workbench in the top right here, and you can actually reconstruct this for just Bitcoin or just Ethereum or just stablecoins. And you can really break this down into many chunks using the concepts and formulas provided in this chart. Now, looking at the market's response to a banking crisis in the US, what actually happened? Well, we saw a bit of an outflow from exchanges for Bitcoin and Ethereum. These kind of longer term trajectories of net outflows from exchanges continue. We can see here for BTC and ETH, this is the exchange net position change. We have seen outflows, right? About 530 million worth has flowed out of the two majors over the course of the last week. What I would also do, let me just zoom this on a 2-year, note that it's an outflow, but it's also not post-FTX outflow. It's also not post-Luna outflow. It's an outflow, but it's not exactly the biggest outflow we've ever seen. So there is a preference towards buying them and pulling the majors out of exchanges, but it's not exactly, pulling them out at the extent that we saw post FTX. It's relatively modest. Now, on the stablecoin side, I've actually got two charts here. The first one, if we were just to look at all stablecoins, or the top four, you would say, boy, there's a lot of stablecoins flowing out. But it's important to remember that BUSD has essentially entered redemption-only mode. So this chart on the right-hand side, let me pull it back on a 2-year, this is showing stablecoins on exchanges excluding BUSD, and you can actually see we've got net inflow. So the takeaway from this, we do have net outflow of Bitcoin and Ethereum overall. So the market has a preference towards the majors, the trustless assets. What we're seeing is that stablecoins, which do have trust, are flowing in. So the overall view here on a spot market front is stablecoins in and majors out. That appears to be the current trend. Now, just note that the stablecoin in is about $2 billion a month. The majors out is about $500 million a month. So there's 4 times more stable coins flowing in than majors flowing out. Still represents a bit of an uncertain territory at the moment. So just something to pay attention to. And that kind of covers the spot markets. Now, moving on and looking at the derivative markets to close out, just to kind of really capture a bit of what's going on. This is a bit more on the micro scale. We're going to start big and zoom in. On the open interest on the left and the futures volume on the right, both ETH and Bitcoin open interest is pretty much at multi-year cycle lows. We are basically back at December 2020 levels, right? Very, very low levels of open interest. Overall, it kind of shows that the market hasn't really woken back up yet. And we're certainly not seeing the explosive growth in leverage and speculation that we saw during the bull market. So still very, very quiet and there's not much going on at this point in time. Trading volume, you can see the same. This was the post-FTX and Christmas lull, a very, very quiet period. We covered that back in week 2 and week 3. We have picked up a bit of volume, but it's still kind of 2020. It's still, 2022. It's still bear market levels. It's not really something to write home about just yet. And across both of these, Bitcoin commands about 60 to 65% dominance. You can see here during the quiet period that BTC and ETH actually converged on a volume front, basically meaning that 50% of the trade volume was Bitcoin, 50 was Ethereum. This kind of speaks to the fact that these assets have reached a level of maturity and liquidity that they can both be traded. But you can see that as the market kind of woke back up, that dominance reverted back to the kind of natural 60-40 that we tend to see across many of these dominance metrics. Now, on a more micro scale about what happened, I mentioned at the start on our price chart, we had that dip down to 19.8 and then a rally up into 24 now. I mean, it just the thing has certainly got some legs to it. What we have here is our total liquidations for Bitcoin on the left, Ethereum on the right. We saw a fairly similar on the wave down, on the trade down to 19.8K. We saw that long liquidations for Bitcoin were about 80 million over the course of a day, and for Ethereum is about 60 million. So a fairly substantial amount of people were caught off guard by that sell-off down to 19.8. But interestingly, we then saw a recovery where BTC had about 55 million worth of shorts that got squeezed out, and Ethereum actually had a lot more at 80 million in shorts that got squeezed out. So and then if we actually look down here, this is the funding rate spread. So this is the difference between the funding rate or the interest rate that traders were paying to be short Bitcoin or to be short Ethereum. The first observation, this is relatively small compared to FTX. So it shows up, it's a blip. It's a more significant event that we've seen over the last 6 to 8 months, but it's nothing compared to FTX in terms of scale. Let's zoom in on the 3-month. What you can see is note that the funding rate for Ethereum went far more negative. Traders were willing to pay negative 48% per year to be short ETH, and they were willing to pay negative 27% to be short BTC. So what that you can then see, we had much more, almost double the amount of short liquidations. In the futures market, this is really describing that the speculative interest, the people who are really punting on this thing, are essentially using Ethereum as a higher volatility, higher trade return asset. They're putting more speculative capital to trade Ethereum, and many of those folks, $80 million worth of them in this instance, got carried out as a result. So what we can see is that it was actually driven partially by a long squeeze on the downside and then a short squeeze on the upside on both assets. And there was a lot more short interest that piled into Ethereum, and they were actually the ones that got squeezed out the most. So it kind of shows you what's going on at a more micro scale. Now, the last chart, I'm actually going to pull this up on the full screen. So the last chart that I want to look at is bringing those two worlds together. We've got the world of our leverage futures trading, and we also have the world of our spot on-chain. And now I get a lot of people say, but hang on a second, so much of the trade volume is in futures, or so much of the trade volume is off-chain. Well, what we tend to see is if you think about that from a statistical framework, you've got two subsets of the market who are all interacting with, in this instance, Bitcoin. You've got people who are expressing their view about Bitcoin via leverage futures. You've got others who are expressing their view by self-custody and holding coins on chain. And you've got others who are sending coins to and from exchanges to trade spot. So in all of these instances, we're talking about very, very large volumes of people and coin. Billions of dollars of Bitcoin flows in and out of exchanges every day. It's a significant amount. And actually the net flow is typically only a couple of percentage points. So on net, when you take away deposits and withdrawals, the net is about 5% at most of the total volume. So there's a lot coming in and out every day. So what we're actually seeing is two statistically significant groups, cohorts of Bitcoin traders or Ethereum traders, depending on what asset you're looking at. So those who are where somebody is making a decision to send their coins into an exchange, that will show up in metrics like SOPR, which is telling us their profit and loss. When somebody happens to be selling their coins at a profit, the funding rate tends to also be high because someone else is willing to go speculative levered long at the top. Likewise, during these sell-offs, someone is capitulating out of their coins. They're saying, get me out of this thing. I just need to send my coins to an exchange and be done with it. At the exact same time that somebody else is putting on a highly levered short. So these behavior patterns actually play out across both of these markets, and they're quite correlated because they're two subsets, statistically significant subsets of people expressing a view about the asset. One just happens to be doing it via on-chain transactions and spot, and the other one happens to be doing it via a leveraged futures position. So if we then zoom with that context, let's zoom in on the last 3 months, similar to our liquidation chart from before. What I want to highlight here, so our funding rate in orange went very, very negative. It went into deep backwardation. That's what we were looking at before, where the funding rate spread blew out. Now, interestingly, actually, let me pull this back on a 1 year just to pick up one final thing. We are looking at short-term holder SOPR here. So people who acquired their coins in the last 155 days. So what was happening 155 days ago? Well, we hadn't quite had FTX blow up yet, but we were in a very quiet period and we were trading somewhere down around 19,000. Now, 19,000 is important because we didn't get down there during our sell-off. However, somehow, if we look at all of this last 155 days, the only place during this sell-off that you could have possibly been underwater on your coins is if you had bought the local top. All of these coins back here and all of the post-FTX coins, these are all in profit. So SOPR should be trading above 1 for short-term holders because all these people are in profit. So the only people who could possibly be selling their coins and spending their coins on chain and locking in a loss are people who bought the local top. So what's important is that short-term holder SOPR traded down below 1, indicating that the people who are spending are local top buyers. Now, there's an exercise here. We have a dashboard called Spending Dynamics. I strongly recommend going and following up with this analysis. Go and have a look at Spending Dynamics, and you will very quickly see that the amount of transaction volume at the moment is quite quiet. And there's particularly not a great deal of older coins on the move. Some of them are, but for the most part, coins are the chain's pretty quiet on the whole. So therefore, let's just, for simplicity's sake, most investors on chain are not doing much. Those who are doing a lot are the short-term holders, and those who are doing a lot are short-term holders who are locking in a loss. So what we're seeing is that on that sell-off to the downside, we had the main people who were spending were local top buyers. And at the exact same time, somebody else was going levered long and paying negative 25% to be short Bitcoin, both of these at the exact wrong time. That then gave rise to a significant short squeeze. So it's kind of interesting where you can see these two markets playing off against each other. And when you kind of isolate these things, you're saying, okay, where were the investors who are selling at a loss? Well, they're top buyers. Top buyers are the most reactive, most responsive. they're the most likely to panic when price goes below their sell point. Then you get the market go into backwardation. There's a lot of conditions there for a short squeeze, and that's exactly what we saw play out. People are willing to go more speculative short on ETH because they think this thing's going to zero, and they all get squeezed out. So you can see how many of these factors play out one after the other. So thanks for tuning in for that session, folks. Hopefully you found that useful. For your homework, I do recommend going and checking out both our realized profit and loss and our spending dynamics dashboards. They will give you a bit more information regarding that last section we were talking about. Certainly in terms of assessing what the how dormant the chain is, so you can kind of isolate the spending. It has been a pretty consequential week. We've had a few of these over the last, let's say, 24 months. So, what we're basically seeing is there is a transition towards self-custody of trustless assets. We are seeing a bit of nervousness in the stablecoin space, but overall, it is a time of being cautious because there is a lot of moving parts. There's a lot of very big, significant events that are playing out. So it is a time to really just be quite cautious because it's a lot can change as we discovered in just a handful of days. So hopefully you found that useful, and I will see you in the next one. Cheers.